Internal and Swiggy, but let's get in a fundamental sense of where the markets are headed and select pockets of markets. Which ones are looking good? Which ones should you be avoiding right now? To discuss that and much more, we have Mr. Ashi Anand, founder and CEO at IME Capital, joining us in the studio today. Ashi, hi, good to have you with us in the studio. And give us your take on, first of all, the overall market, the kind of market breadth we're seeing. Yes, Nifty has reacted well to the policy. Midcaps are holding well, but nothing seems to be cheering up the small cap end.
Yeah, sure. So I think it's been a year and a half, right, of a fairly sideways market. And what we have seen is after the fairly sharp run-up after COVID, markets did need a certain level of a breather, especially the broader market. The markets are basically combating a few headwinds. You've had a lack of growth, you've had interest rates which are high, you've had geopolitical uncertainties. Now, the important of the interesting part is that over the last 3 to 5 months, you are starting to see some interesting tailwinds. Growth has started to come back. I think after many quarters, there were some signs of optimism coming up from the recent quarterly earnings season. While you are still single digit on the Nifty, the broader markets will have about a 14-15% overall earnings growth. And more importantly, I think commentary in terms of an improvement in the growth outlook was seeming a bit kind of relatable. Importantly, you've had interest rates come down, you've had GST cuts, you have had income tax cuts at the start of the year. This does add to quite a decent amount of income in the hands of consumers. So you've had growth, a major concern, starting to come back thing. You have interest rates starting to kind of fall, including, importantly, global and the US Fed interest rates. So there are important factors which are turning positive, which should improve the overall outlook on the market. Key headwinds obviously are what's happening in terms of the US-India trade deal. And you are seeing kind of pressure on the rupee. So I think some kind of a positive announcement around there is something which could really help market optimism get back, and hopefully we could enter the next phase of the market.
Okay, Ashi, hold that.
Still with us. Ashi, you run two funds. You've spoken a bit about how you're viewing Indian markets. Talk to us about what are the themes that you're liking, especially on the flexi cap stroke, large, mid, small cap side of things. What are you liking at this point? Earnings re-rating likely over maybe the next couple of quarters or thereafter. How are you playing that?
Sure. So I think the core themes that we are focusing on right now in our FlexiCap mandate is, one is clearly the digital ecosystem. We have large overweights in that core theme. We really do like banks. We see a lot of value in banking and banking across themes, both kind of the leading franchise banks, the likes of the ICICIs and the Kotaks, as well as kind of the value players, the SBIs, the Axis and IDFC. We see a lot of comfort in terms of the risk reward in banking. There was NIM pressure, there was asset quality issues. Both of these seem to have bottomed out. And we believe the earnings growth trajectory should improve from here. So that's the play. BFSI, other segments, capital markets is another segment that we are quite bullish on. So we have reasonable exposures there. I think we have incrementally been increasing exposures to consumer names. What we had alluded to that in terms of, they are just multiple sub-trends which point towards a kind of an improvement in the kind of the consumption outlook. So we do have certain FMCG names, we have certain retail names. Real estate is another space that's been under pressure for some time. But if you're actually seeing underlying pre-sales data, I think the underlying market is still quite kind of positive. So a lot of our kind of focus is around these kind of names. We're staying away from things linked to global. We just believe there's a lot of uncertainty around trade, around the currency, around different multiple moving parts. And also I think capital goods is a space that we had very healthy exposures here. We have cut them over the last year. Valuations had moved up, but we're kind of waiting for the underlying growth momentum to kind of come back.
So the view is purely domestic right now? Bias
Largely,
is at least
yes.
domestic? Okay.
To a fairly decent extent. I think with the currency depreciation, it is quite positive for Indian IT. Indian IT is a space which has underperformed very high qualities, companies available at quite attractive discounts. So if you get greater clarity on a recovery in US earnings, that is that we could also be quite interesting.
Okay. And Ashi, financials, that will remain in focus given the rate cut. How do you play that? Where are you seeing value within financials?
So I think the interesting part is financials, especially lenders, right? There is quite attractive valuations available across the kind of curve. If you're looking at very consistent compounders of longer term wealth, right? The Kotaks, the ICICI Bank, HDFC Bank is starting to kind of come back. These are available at about 2.5 times book. Those kind of valuations can be supported, and you have an underlying growth or underlying advances which have the potential to grow at 15 to 20%. So you don't really need a valuation re-rating to make quite healthy double-digit returns on these companies. On the other hand, other end of the spectrum, companies like an SBI, companies like an Axis Bank, an IDFC Bank, these are some of the kind of companies that we hold. Not only do they have fairly attractive earnings growth, but we also believe that there is scope for valuations to move. And that is actually really a golden mean, right, in terms of stock return. So those are kind of some of the places we're looking at in finance.
Okay, we'll take a pause there, slip into a break. On the other side, we'll continue talking with Ashi, and of course, we're at the fag end of this week's trade. 15 minutes to go. It's a good day of trade. We'll try and wrap that up as well. Stay with us here on ET Now.
Back with closing trades, you're catching us live from the SBI Live studio. Only about 10 minutes, or in fact lesser than that, to go for the market to end up for the day and for the week. We'll take stock of how the market has performed for the week in a few minutes from now. But we are in conversation with Ashi, who's joined us in the studio today. Ashi, we've spoken about some of the themes you like. What about the ones that you're cautious on right now?
Okay, sure. So, pharma is one space. It's done reasonably well over the last year and a half. But I think the one thing that is important if you're looking at kind of pharma and pharma companies, especially US generics, is there was one particular drug called Revlimid, which accounted for a very, very high level of profits for a number of companies. This is going to create quite a difficult base for companies to grow on, and therefore we believe overall earnings growth in the pharma space is going to be subdued over the next couple of years. I don't think markets have necessarily completely factored that in. It's not that we're negative on pharma on the whole. You just need to be very stock specific. You need to be very careful about what companies are likely to have interesting drug opportunities coming in that can kind of take care of the Revlimid opportunity. Ex-US generics, there's branded generics, the whole India story, Indian healthcare, all of those are still quite interesting themes. IT, we have been quite cautious about. You have kind of uncertainties around what's happening with the US economy. These companies are struggling to kind of grow in double digits. And also the whole implication of how positive or negative AI is going to be in their business models, that's still something a bit unclear. We like capital goods. We just think that at this point in time, valuations may not be in your favor. You need a stronger evidence of kind of earnings coming back more strongly for that to actually think. So I think those are some of the themes we're being a bit cautious about, but it's more stock specific. We kind of think there's still stock specific opportunities out here.
You run a digital fund, Ashi, and a large part of that is extremely concentrated. Is that purely because of the fact that there are limited options and therefore you like very few? And does this new IPO rush give you the much required room to play in a more holistic fashion, to play it more with better diversification?
No, sure. Thank you. That's a very interesting question, right? So I think firstly, in terms of the current level of concentration, about 5 stocks contribute about 90% of the portfolio currently, which is probably amongst the highest levels of concentrations you see on a PMS portfolio in the market. This is actually driven not so much because the universe is limited. There are about 25 to 30 companies that you could call pure listed digital platforms. We tend to bet on what we believe are going to be the long-term winners, right? And there are extremely tough selection criteria around competitive barriers to entry. Have you achieved dominance? Is there threats of disruption? Multiple elements that go into, are you going to be one of the long-term winners of the space? There are not too many companies that actually tick those boxes, and which drives the current levels of kind of concentration. The new wave of kind of IPOs, and there are some very interesting digital companies that are being coming up for listing, that actually becomes very interesting from our perspective because it actually helps us run what we believe to be a diversified portfolio of the fastest growing companies across a wide range of segments. So yeah, we are looking at the new IPOs that are coming up quite closely in the digital space. We believe that could actually open up the scope to increase the number of companies, increase the levels of diversification while not moving away from the core investment thesis of ensuring we are betting on companies that are likely to be the long-term winners in the space.
Ashi, you've always spoken about deep moats, and you've traditionally tracked them, and you've got a reasonable hit rate on that, historically, Kotak, ICICI, and the like. Give us a sense of what you make of 2-3 companies which have traditionally had very strong moats. You've got an Asian Paints, Indigo today, with everything that's playing out, a Page Industries, for example. Again, very deep moat, but very unliked at this point. Are these opportunities to maybe buy? Asian Paints, of course, was 6-7 months ago. We've now hit almost 3,000 on Asian Paints. Do you believe that those moats can continue, in your opinion?
So I think there are two elements, right? One is the business and the other is the stock, or the view on the stock. I think these moats are quite strong. Asian Paints obviously has had increased competition coming in, and for a very long time, it's just been a 2-3 player market. So you do have to kind of factor in for the fact that there is new competition coming in. It's not that new competition will necessarily disrupt Asian Paints, but it's just that you can't use pricing levers as aggressively when you're trying to ensure you're defending your turf. I think the problems on these companies aren't really the businesses per se, as if you just go back to what's happened from kind of 2015 to 2020. There was an extended period of time when there was nothing happening in the economy, nothing happening in multiple trends, in multiple other sectors, and therefore there was a huge gravitation of money towards very high quality banking, NBFC and kind of consumer franchises. Valuations of a lot of these companies have actually moved towards levels which honestly are just extremely hard to justify. No matter what you take in terms of longer term DCF assumptions, it becomes very, very difficult to justify those numbers. So what's happening in these companies is that you have valuations that arguably will keep coming down as you're going ahead, just as they move back towards normalcy. And you have earnings growth, which is still around kind of low double digits. It's not extremely high growth rates. That high valuation base is, according to us, the problem. And that is what that is why these stocks are kind of broadly unloved at this point in time.
Okay, actually, I wish we could extend this conversation further, but we're just about at the day's end. So thank you so much for your time today. Good to have you, and keep coming more to the studio so that we can have longer conversations as well.
Thank you so much for having me.
Thank you so much. Okay,
Pleasure
viewers,
entirely
with that, we have about 2